Do you want to know what is the simple, easy, and reliable path to growing wealth? I will share my understanding about this book by J.L. Collins. And by the way, I'm not an investment advisor, and I'm neither affiliated to the author or the publisher of this book. And all the information I'm sharing are my understanding and how it resonates with my long-term wealth building. The key audience here are the beginners in investing, also who are wondering why the fund managers are not able to beat the market consistently. First, the time you are in the market is more important than the timing of the market. This means you should consistently invest over a longer period of time instead of waiting for a correction. At the beginning, choosing the broad market, low cost funds like Vanguard's VOO, VTI helps you save the management fees. These are critical differentiators compared to choosing a fund manager who usually charges 1 to 2% of the portfolio, which is a constant drag down every year in your portfolio. While no fund manager promises to beat the S&P 500, they charge the fee upfront. So you have the advantage at the day one of joining a broad market fund. If your strategy is not extremely aggressive, always diversify your portfolio to have bonds which are relatively stable than the stocks. This book recommends like 60-40 or 70-30, meaning 70% stock, 30% bond when you are moderately aggressive. At the same time, the next key component is this ratio is not fixed. You should switch to like higher percentage of stock to a lower percentage of stock as you age, because you wanted to have less volatility in your portfolio as you approach the retirement age. So your portfolio should align with your age, and that's why this book recommends target date funds if you don't have the patience or enough knowledge to like constantly rebalance. And the other cost is if you're using a portfolio that is not tax efficient, rebalancing itself becomes a pain because every time when you rebalance, you sell the stock and you have to pay tax, either a short-term or long-term gain tax. This takes to the next point. You should prioritize leveraging any tax advantaged accounts as much as possible. For example, contributing to 401k, Roth IRA, or HSA. These kind of accounts should be leveraged if you have an opportunity. And all these things come with a downside. You may not be able to cash out immediately when you want. And hence, we should prioritize having the right set of short-term needs covered in your emergency fund in cash. And also, the other learnings I had, which was not clearly covered in this book, is try to avoid forcefully rebalancing your portfolio just because the stocks have gone up. At times, the stocks stay highly volatile and highly valued for a period of time, and they naturally correct. So, unless you had a need to cash out and then like take the profit and then still pay the tax, don't do that. The alternative suggestion is this is an opportunity to invest your new money into the low valued component of your portfolio. For example, if the bonds are like cheap because the stocks are like highly valued, put your new money more into the bond than putting your portfolio through the rebalancing process. It also suggests diversifying beyond your own home country. if you're in US, investing in emerging markets or vice versa. And I also have additional opinion on the diversification. Some people think investing in REIT is good diversification. I have done it and found it's not accurate. Any investment within the same stock brokerage related to the equity will have fluctuations caused by the broader market fluctuations. So comment in this video if you want to know more about like what are true diversification beyond stocks, that I can share my experience. If you find this information valuable, like and subscribe, and if you want your friends to be aware of it, share it with them.